Good evening, Namaste. I welcome you all to this weekly Vichar webinar series. My name is Surya Soni and I'm former president of Federation of Indian Association of Victoria, current trustee of FIV and AICCT. So this is a initiative from FIV where over last 15-20 years I've realized there's a gap for people to people connect in the community in Victoria. Hence, this webinar series is trying to bridge that gap where we listen to each other, we bring issues and concerns of the community on this forum, we discuss on very diverse topic and we bring ideas. FIV and myself firmly believe there's a huge pool of talent in our community in Victoria. We can learn, listen to each other, and avoid the pain one has to go through by sharing that knowledge and wisdom. Collectively, we can grow our wisdom and be a better community overall day by day. Without further delay, I welcome our speaker tonight, Chandresh Painter ji. Welcome, Chandresh ji. You've been
Thank
so
you.
kind to bring this very important topic for the community. We all believe that default insurance in our super is best, but you are going to bring in some light tonight on what are the various issues and challenges or what are better options, alternative options. So I'll briefly introduce you. Chandresh Painter ji is the founder of Insurance Guru and a life insurance specialist with over 24 years of experience helping families and business owners protect their financial future. He specializes in structuring sustainable, affordable cover that safeguards income, lifestyle, and legacy, particularly for clients with complex medical histories. That is very important. So, with that note, the space is all yours, Chandreshi. Over to you. Thank you.
Namaskar and good evening, everyone. It's welcome to you all and thank you for your time today. I have this mission and passion whereby I would like to educate each and everyone who comes in touch with me with regards to highlighting the importance of why not having your default life insurance within your super. The most important thing which I would always like to highlight here is what exactly is the intent of life insurance. The complete intent of life insurance is primarily to protect the financial security for the person and the family and the future of the family with regards to maintaining the quality and standard of your life. If anything happens, such as untimely death, unable to work temporarily, unable to work permanently, or being diagnosed with a serious medical condition. I've spent over 25 years
Chandreshi,
specializing purely in life insurance.
Chandreshi, apologies. I'll pause for a second.
Yeah,
I forget to speak about the disclaimer that this webinar is for information and
that's
education
correct.
purpose
Yeah,
only, not a
please.
financial advice.
Yeah,
Please take all the due diligence and take a financial advice and take this webinar as only for education purpose.
yeah. Cheers. Thank you so much. Yeah, that was very important. Yeah. The important thing is I've got a very unique position in the industry. I have extensively worked in claims, seeing firsthand what gets paid, what gets reduced, and what gets rejected. The very important thing is what is the importance of life insurance? As I said, what is the intent of having life insurance? The sole purpose of life insurance is to protect the policyholder and their family financially to maintain the quality and standard of living. Even if something happens, such as untimely death, which is a death policy, unable to work temporarily, called as income protection cover, or permanently disabled, called as total and permanent disability, or when diagnosed with a serious medical condition. So, what it does is it basically protects the policyholder and the family financially in times of drastic life events and uncontrollable incidents. The one simple truth is life insurance provides security to the family and is the most important pillar of any financial planning. And therefore, the Australian government has not only provided this as a default in your super, but also allows you to pay the premiums via super. Can you pay premiums for your car, your house, or any other things like your appliances via super? No. Has the government given anything as a default cover? No. And that itself should impress each and every one of us the importance of having life insurance. And I assure you, I have seen the importance of it, having done claims for 14 years. I have seen how desperate situations people are in when they are on claims. And I can tell you this with confidence: most people believe they are protected, most people are not. The one simple truth is, how many of you have thought that I've got life insurance in my super, so I'm covered? That's the biggest myth in Australia. Super funds automatically include insurance, so people assume it must be enough, it must be good, it must be designed for families. But in reality, super insurance is designed to be cheap, basic, one fits all, not personalized, not comprehensive, convenient. Convenience does not mean adequate. So, my mission here is to bring out the facts as to why the default life insurance in your super is not super. And let me assure you, there are 20 reasons as to why the life insurance which is provided to you as a default in your super is not super. What life insurance really needs to cover is to cover your mortgage, your living cost, your school fees, your medical bills, your business debt, and the most important, your lifestyle protection. Now, here's what most super default cover provides: it provides a modest lump sum that often only clears part of that mortgage. Then what? The surviving family still needs income. I've seen families burn through payouts in 2 to 3 years, then struggle financially for decades. Life insurance isn't about paying debt, it's about protecting your way of life. So now we go. As I said, there are 20 reasons as to why that default life insurance within your super is not super. The very first disadvantage is that the policy holders have a incorrect impression that the premiums which are paid from your super, they are the cheapest. Let me assure you one thing: if you take up those same policies which are so poor in their benefits, sorry to use the word, the rubbish policies, if you take up those same rubbish policies with an insurance company, your premium is much cheaper than what you are paying right now to your super. I'd like to logically explain this fact to you. What super does is, it does not take into consideration the age of the person. It does not take into consideration whether somebody is a smoker or a not non-smoker. It doesn't take into consideration whether you have a medical condition or not, what is your occupation, etc. It puts everyone in the same basket and then divides the premium to be shared by everyone. Now consider life insurance taken with an insurance company. They take into consideration your age. They take into consideration, if you don't have any medical conditions, you've got a better advantage of being given better premiums. They consider if you're a non-smoker. They even consider your height and weight, your BMI, and so on and so forth. And therefore, logically speaking, it is like your family and my family, we go out for dinner. I don't eat anything today. I've got a fast. I don't eat anything today. What does super say? Super says, I don't know whether you've eaten anything or not. Share the bill equally. The insurance company says, hi, Chandresh, you haven't eaten anything. Don't pay anything. Even if I'd eaten something, they would have said, just pay your bill for whatever you have had it. And that's where, logically speaking, there's a greatest disadvantage, and people feel that what you've got is cheap. It is cheap because the policies are also very, very poor. The second greatest disadvantage is that the insurance policies which are default within your super are not guaranteed renewable. Remember, any life insurance policy which you have with an insurance company, it is guaranteed lifelong. They can never ever water down your benefits. And the third most important disadvantage which people don't understand is that super policies can only provide you any occupation TPD. Now, let me just brief you on what this any TPD and own TPD is. Primarily, I forgot to mention this that there are three policies which are given as a default in your life insurance, in your super, and that is life death policy, TPD, and lastly, income protection. Now, in TPD, there are two types of policy, what is known as TPD own occupation and TPD any occupation. TPD stands for totally and permanently disabled to that an extent that the person will never ever work in their life. If I'm assessing this claim, I need to get two specialist doctors certifying the policy holder that he or she will never ever work in his or her life. It's not easy to claim. Now, let me give you a claim example to clarify you what this TPD, any, and own occupation policies mean. I had a claim for a surgeon who suffered from a stroke. His whole right side got paralyzed. He was unable to lift his right hand, and he was a right-handed surgeon. So I got certification from two specialist doctors certifying him that he will never ever be able to perform surgery on his patients. This surgeon did not have an own occupation policy. So what happened? So when I assessed the claim, I took into consideration his education, his experience. Besides that, I can even retrain the person to work in any other occupation. So if this surgeon is able to teach medical students, if this surgeon is able to do medical proofwriting, if this surgeon is able to answer to medical queries in a call center, he will not be given the TPD claim because the TPD claim, because its TPD policy is TPD any occupation. Remember, super can never give you any own occupation policy, and therefore the policy is very, very poor. Now let's go to the next example. The fourth disadvantage is that default life and TPD covers from super fund is inadequate for most people. They never come and ask you, what is your outstanding mortgage? What are your outstanding debts? Is your wife working? Are you the sole and whole sole person to earn for the family? Do you have large debts in the form of business, investment into business, etc., etc.? They just give you something lump sum, which has got no meaning. The fifth disadvantage is that tax may be deductible when a life or a TPD policy is paid under super. So let me assure you one thing. If somebody is paid a TPD, any occupation policy via super, there is a tax liability between 19 to 22% depending upon your income slab. Oh, sorry, the tax slab depending upon your income. The sixth disadvantage is that super fund trustees have a discretion on who will receive your death benefit. Your choice of beneficiary is limited under super. The eighth disadvantage is that the insurance policy may not be portable if you change superannuation funds. you need to apply everything again. So, therefore, to summarize, super insurance is designed to be cheap, basic, one size fits all, not personalized, not comprehensive. People only discover these issues when tragedy strikes. Going further, the ninth disadvantage is that life insurance through super may have general exclusions. So, these exclusions you will not be aware of. You will be shocked and surprised to know them only at claim time. Super insurance cover will cease if you stop contributing or your balance is too low, or especially as soon as your super is done and dusted. Now, let me tell you here, your life death policy, if you start paying the premiums from your pocket, the life death policy is valid up to the age of 100. I always look at life death policy as a savings and as a tax free money to the family. Imagine whichever partner passes away first gets the life death benefit, which is in millions. And to the partner, this is tax free if the policy is outside super. Even if the second partner has to then pass on this to the children, and if the children are about the age of 18 and are earning, they will have to pay some tax. But imagine somebody getting life cover of 3 mil, of which they have to pay 250 to 300,000 as a tax. It's still a large amount of money which goes to the family. The premium which you pay against those premiums, the premiums which you pay against those high benefits is peanuts. What does super do? Super starts reducing your benefits once you pass the age of 50, 55, because the premiums are so high that it'll start emptying your super. And that is where the structuring of life insurance is very important. I will speak about that aspect later on once I complete the disadvantages, 20 disadvantages of having your default life insurance within your super. Now, super insurance policies offer fewer benefits. Income protection through super has a weaker definitions of total and partial disability. No personal tax deduction for income protection premiums under super. So this is a very important thing. If you pay for your income protection policy, the premiums from your pocket, the premiums are tax deductible. So the greatest advantage you have here is that you are able to keep your premiums under control because you get back the percentage of premium you have paid, whatever is your tax slab, back into your pocket, although the complete premium is tax deductible. For example, if somebody is paying $1,000 as an income protection premium on yearly basis, the insurance company will usually send out a letter to them at the end of the financial year. And if that person is at a tax slab of 33%, $330 will be back into his pocket at claim time. So one needs to remember that there are distinct disadvantages of not having your default life covers. They are not sustainable. And the most important thing, which I'm going to speak later on, is on structuring your premiums. And I assure you that you cannot take level premiums when you got your policies from your super. Okay. So, in short, super insurance is automatic, meaning no medical checks initially, easy to get, but has very limited protection. Because when insurers don't assess health upfront, they protect themselves later through strict claim definitions, exclusions, lower benefit limits. Also, many people don't realize that cover often reduces as you age. Some policies stop at certain ages, and many funds quietly change terms. It's designed to keep premiums low, not coverage strong. This is where my claims experience really matters. Common claim problems I've personally seen with policies which are within super is pre-existing conditions used to reduce payouts, TPD definitions so strict people can't qualify, projection rejected, income protection claims rejected due to work type, mental health type, casual employment loopholes. People only discover these issues when tragedy strikes. That's the worst time to learn your policies isn't solid. Insurance is only as good as its claim conditions. So let me explain to you. I'm sorry, I haven't put the slide up. The way you can structure your premium is the most important thing for you to see that you are able to keep your policies when you really need it. And that is after the age of 50, 55. The way you can structure your premium, there are two ways you can structure your premium. One, which is known as step premium, the other, which is known as a level premium. There's a new terminology now for step premium, which is known as variable age, and level premium known as variable. I'm just going to elicit this through an example so that it's easy for all of you to understand as to why you need to structure your policies correctly. If not, you will not be able to keep your policies after 55. Suppose one is taking a life cover of 1 mil, and we are not increasing this amount every year, but we are keeping it as non-index, which means 1 million of life cover from today till the age of 70. If it is step premium, even though your benefit amount is not going up every year, still your premium has to go up every year as you grow in age. With level premium, the premium is calculated at the age at which you have taken your policy. So, what is the practical implication of structuring the policies as stepped or level? The practical implication is step premium is cheap when you are young. Please mind my words. It starts hurting your pocket when you reach 50. It starts becoming impossible to pay at 55. And it's impossible to pay the premiums if they are structured as step premium after 60. You tell me, when do we really need all these covers? Is it before 50 or when you are 38? From the claims aspect, if I tell you, only 10 to 15% claim are idly there before the age of 50. What is level premiums? Level premium, you pay much more than step premium when you commence your policy. Between 12 to 15 years, the stepped and level premiums become equal. It depends upon the age at which you have started your level premium, and it also depends upon how large your benefit amounts are. Once the stepped and level premiums become equal, which is between 12 to 15 years, the level premiums become much, much cheaper than step premium, and you can easily afford to keep your policies till you retire. Very important thing is the cumulative premium which you pay for step premium. So that is the premium you pay from the time you bought the policy till the age of 70 is much, much higher than level premiums. So in short, level premiums are overall much cheaper than step premium. And it is only the level premiums that will allow you to keep your policies when you need it after the age of 50, 55. Now, let's speak about the real cost of cheap premiums. Every premium comes out of your retirement balance if you are paying the premiums from your super. But at the same time, it exposes you to higher claims restrictions and uncertainty if you are still got your default life insurance premiums in your super. It covers insufficiently for your lifestyle and current liabilities and debts. Looking into the next step, what's proper protection looks like. Proper protection is one which is tailored for you and your family. It pays off mortgages, loans, or outstanding obligations. It also funds children's schooling and future needs. It is designed to last to retirement and beyond. It supports families after loss of an earner. And it is structured to stay affordable, sustainable premiums to not add pressure to the cost of living is the most important thing, which allows you to keep the policies when you really need it up to the age of retirement. So, properly structured life insurance should be medically underwritten upfront, having clear claim definitions. It should be tailored to your family, designed to last till retirement, and structured to stay affordable. This means better claim certainty, higher benefit quality, no nasty surprises later, and yes, it can still be affordable when done properly. This is where expert structuring matters. Now, I would quickly like to give you a brief review of what are the other policies which you cannot get if you've got life insurance as a default into your super. The most important cover which you don't get has three names. It's known as a trauma, critical illness, or a crisis recovery policy. Critical illness is the right word to describe this policy. This policy basically compensates a person if they are diagnosed with 42 medical conditions. These are serious medical conditions which can disable a person, can incapacitate or reduce their capacity to work, may incur huge cost for treatment, and that is where this policy's importance comes into play. This is a policy which you can never ever pay via super. Please remember, even when you take your life insurance covers with an insurance company, you can still pay the premiums via your super. But you got the advantage of the portability. It is your call whether you want to pay from your super or from your pocket. The ideal strategy is as soon as the step 10 level premiums become equal, or you feel you've got the affordability to start paying the premiums from your pocket, you should come out of super, because whatever is paid via super, the policy is still owned by the super. The SIST Act, which is the Superannuation Act, still applies to those policies. Let me give you an example of how poor benefits are with regards to any covers which are as a default within your super. A simple policy like life death policy. If this policy is under super or is paid via super, there are three benefits which a person will not get. And those three benefits are funeral benefit, financial planning support benefit, and what is known as a mental health care support benefit. When we assess a claim, we do not need to do the complete assessment for a life death claim. Even if a paper cutting is sent to our office, saying that this person has died, we do an upfront payment of $20 to $25 if the person has funeral benefit and if the policy is outside super. The money which is received by the family, such a large amount of money, they will usually go to a financial planner to put it or to place it in a right way to utilize the money in the best way. And therefore, they have to pay the financial planner for doing that planning. Remember, the insurance company pays up to $3,000 for that financial planning. You do need to provide them the receipts for the payment you have made for the financial planning. And lastly, mental health support. Let's consider the example of the Air India flight, where nobody expected their loved ones to die that way, and that suddenly. In such a scenario, people do get into mental health issues such as depression and whatnot mentally. The insurance company provides support and pays for the consultation with the psychologist for the treatment in such a scenario to the only near and dear ones of the person who is a policy holder. So this is just one example where I've elicited that having policies within super, there are a lot of disadvantages and there are a lot of things, good benefits which are not provided. Now, let me give you an overall picture with regards to the claims. I have been a claims person. Now, if you consider the four important life insurance covers, which is life death policy, TPD policy, income protection, and critical illness, 80% of all claims are income protection claims. The only policy which is a life policy is income protection policy. Since income protection claims are high, the premiums for income protection is high. All other policies are once in a lifetime. A person is going to die once, is only going to be permanently and totally disabled once. If unfortunate, he might have 2 or 3 serious medical conditions. And I have paid claims where somebody has had a heart attack and then somebody has had a stroke and somebody has had a cancer, and we pay for all those conditions. 80% is income protection claims. 15% is shared between death and critical illness. Only 5 to 8% claims are TPD claims. So I've given you an idea with regards to what is important when you have your policies. Now, let us look at what is the most important time for you to review your policies. Even if you have policies, it's very important and you should know as to when you should review your even existing policy. If any of these apply to you, a review is critical. If you have a children, if you have a mortgage, you run a business, you have medical history, you rely only on super, most people I review are underinsured by 40 to 70%, not by choice, but by default. Just to recap what I have said, proper structure reduces risk exposure. It shields you against unexpected financial shock. It supports growth, encourages investments and entrepreneurship. Default super insurance is basic. It's got limitations and exclusions, creating avoidable stress when tragedies happen. Life insurance outside super strengthens families, provides safety nets across generations. My mission is simple. Super insurance is basic. Claims are where limitations appear. Proper structure protects your family's future. My mission is simple, and that is to make sure families don't find out this too late. To encourage everyone who has default life insurance and super to take up life insurance with an insurance company. Remember, the policies which you have in super are much cheaper with an insurer. Everything we have discussed tonight leads to one simple truth. Most people aren't underinsured because they have made bad choice. They've underinsured because nobody ever reviewed it properly. Super insurance is set and forget. Life doesn't work that way. That's why I offer what I call a life insurance health check. It's a simple, no obligation review where I analyze your super cover, identify claims risk, calculate what your family actually needs, show you smarter structuring options. Most people are shocked by the gaps we uncover, but relieved to finally have clarity. There's no pressure to change anything. That's where reviewing your policy is the most important thing one needs to do to secure your financial security for yourself and for your family. I truly call myself as a specialist in life insurance, a real life insurance guru. And the reason I do this is because I have unmatched experience in this field. With 24 years in the life insurance industry, I have developed a profound understanding of how policies work, how to structure them effectively, and how to navigate the complexity of underwriting and claims. My 15 years experience of claims, including serving as a medical specialist for a claims team, gives me an insider's perspective on how insurers assess claims and how to position policies to ensure the best outcome for clients. I'm an expert in claims and PDS interpretation. My background in claims means I interpret product disclosure statements with precision, ensuring clients fully understand their coverage and avoid unpleasant surprises. I guide clients through the claims process, maximizing their chance of successful payout when they need it most. I provide comprehensive protection strategies. As a one stop insurer specialist, I provide expert guidance on life insurance, income protection, TPD, trauma, child cover, and business expenses policies. My goal is to ensure families maintain their financial security and standard of living in the face of unexpected events. I am a strong advocate for clients with medical conditions. I excel in securing coverage for individuals with pre existing medical conditions, leveraging my deep understanding of underwriting and insurers' risk assessment. I know which insurers are more favorable to specific conditions, ensuring higher approval rates and better terms for my clients. I'm a master of policy structuring. I specialize in structuring affordable and sustainable policies that clients can maintain until retirement, ensuring long term protection without financial strain. I'm called and known as a real insurance guru due to the reputations and the results for which I've earned this title through years of delivering outstanding results and securing the best outcomes for clients. My expertise in tailoring policies means I secure maximum benefits at the most competitive premiums, ensuring clients receive the best possible value. I also insist on this fact: the earlier you take your policy, the cheaper they are for you. The earlier you take your policy, you will not have a medical condition, which means your policies will be much cheaper. There will be no loading on your policy, or maybe you might not be able to get even a policy if you've got serious medical conditions. So, this is very important to keep in mind. The earlier you structure your policy, you need lesser benefit amounts because our aim is to achieve a particular level of cover by the time we reach the age of 50 to 55. So this is very important for anyone to understand. The earlier you do, the better for you. It saves you money. It allows you to reach your goal easily without any financial strain on your pocket. So this is what it is: life insurance for a secure tomorrow. I would welcome anyone. I will not be charging anyone. This is free consultation in case if you would like me to review your covers or you would like me to discuss anything. I also don't mind anyone in assisting in processing their claims if they have difficulties in getting their claims. And I also specialize, I want to bring this out very clearly. I specialize in getting life insurance for people with pre existing medical conditions. And this is something which is usually quite difficult. You'll find many people who will not take up this challenge. If things have been cancelled, if things have been not given to you, nobody will go and challenge those things. As I have a medical background, having been a medical practitioner for 16 years in Mumbai, in a very posh locality, and having worked in all these spheres as a medical specialist or as a claims processor, I do have that advantage of dealing with the underwriters. Let me assure you one thing, I don't know whether you all know or not. All life insurance companies have a full time doctors coming to their office because everything in life insurance is only medical, medical, and medical. My role when I was dealing with the life insurance company was to fill up that gap between what the doctors understand as a clinical medicine and what I now started understanding as risk medicine. There's a big difference between the two. For example, if somebody is diabetic, which is very common in the Indian population, your GP will say, don't worry, your HbA1c is under control, you're good to go, your blood sugar is under control, you're taking proper medication. You put in an application to an insurance company, oh, you are a prospective claimant from the day one because you bring the risk of diabetes. They don't control you or how you're going to control your diabetes. If a policy is given to you, it cannot be watered down. And if you put in any claims related to diabetes, they have to be covered. I can assure you from the medical point of view that if somebody has got diabetes and if it is uncontrolled for more than 12 to 15 years, I can assure you one thing, and that is what we call as a target medical conditions such as heart attack, kidney failure, gangrene, which is loss of limbs, or blindness. Diabetes is the second most common cause of blindness, sorry. They are all covered by the critical illness or trauma policy. So the way the doctors look at it and the way the risk medicine or the insurance company looks at it is totally different. And that is where the field in which I work allows me to fill up that gap. I also speak with the consultants and doctors to provide us the certification as required as per the policy definition. Because if you do not meet the policy definition as given in the PDS, we will not pay you the claim. If you meet the policy definition, we will immediately pay you the claim. We don't come and meet you. We don't come and check you out. It all depends upon the medical reports from the doctor. And that is where my background and knowledge comes into play, where I interact with the doctors to tell them exactly what we need. This not only helps the client to get the policies, but also help them at claim time. Thank you so much. I'm open to questions. I think I'm nearly there. It's 39 minutes as for what I see.
Yep. So, yep, there's a question in the chat already from Vimal Galoji, and either you may want to read it directly or I can read it for you.
If you can, please.
Yeah. So the question is, can I increase cover later without medical underwriting if I'm, so that's question number one. So there's a continuous few questions. I'll read out the whole thing.
Yeah.
If I move overseas, does my cover still apply? Can I
That's a very
transfer?
important question. I'll answer that straight away. Is it okay, Suriji?
Yeah,
Yeah.
okay. Yeah.
So remember one thing, all life insurance are valid anywhere in the world. It does not have any restrictions or geographical boundaries like health insurance. You can have cover here. If you move to India, it still covers you for anything. I've got so many clients who have moved to India. I'm handling them right now. No issues at all.
Can I transfer this cover to another super fund without underwriting?
No. Remember one thing, the only default cover which is given within your super is what will not require any medical underwriting. Even to the same super fund where you got your existing super policies, if you want to increase your life cover, say you've got a life cover of 300,000 and you want to increase to 1 mil, they will do extensive medical underwriting worse than what an insurance company is going to do.
Yeah. So he appreciates your tremendous
Oh, you're most
knowledge.
welcome.
Yeah. And
One of the question which you asked me, if you want to increase cover, okay,
yeah,
there are two important things which
without
people,
without
yeah,
medical underwriting.
which people need to remember. When you make an application, if you ask for future underwriting, then you might not require to do any underwriting in future if you increase your covers. Okay, so there is this option available for future underwriting. If you take that up, you will not be required to do that. But if you don't take that up, then what one needs to do is they will have to undergo medical underwriting. And why we do this is, many of the policy holders who have a policy, they will go and increase the covers, especially income protection or even critical trauma, when they come to know that something is happening or they might be diagnosed with something. And therefore we always have to do that. And this is my claims experience, I can tell you that.
Yeah.
Somebody asked about the question. Yeah, sorry, Sriji.
Yeah. So the next question is around, and which is related to my question as well. When you speak about step premium and level premium, you said it is best to start with step premium, but have to best switch to level premium when they both become equal. So when do they become equal?
Yeah. So remember one thing. I'm not saying that you change from step to level premium when they become equal. What I'm trying to tell you here is that when step and level premiums become equal, you will find that you can easily. Okay, let me explain this in a slightly different way for all of you to make things very clear. My strategy is that if you are taking level premiums, the premiums are going to be much higher than your step premium. Yeah. Therefore, you use the super to pay your premiums so that it doesn't hurt your pocket. When you take the premiums, when you pay for the premiums from your super for all the three policies except income protection, which I'll speak again in a slightly different way, you get an advantage of 15% rebate. Why? Because whatever you've contributed in your super is your retirement fund. Government gives you 15% rebate. The insurance companies are very smart. They also create a fund, which is like a super fund, where they collect your premium from your super and put it there, and you get 15% rebate for your premiums. So, what I'm trying to say here is that once the stepped and level premiums become equal, you can then decide to come out and pay for the premiums which you're paying from your super from your pocket, because it is much cheaper now. Your step premium are going to go up. But the golden rule is, the earlier you take level premium, the gap between stepped and level premium is less. So suppose I do a level premium for somebody who's just 25 years old and has just started working. His The gap between the stepped and level premium might be just about $150 to $200. But if I do this for somebody who's 40, the gap could be large. The life cover premium for stepped might be $800, but for level could be $1,800. So the earlier you do, it's advantageous.
Yeah. Can we if we switch from one insurance provider to another
Yeah.
while we are in level, do we reset our level premiums?
No, because why should the other insurance company take on your risk when they haven't received your premiums?
So it
So
will reset,
remember
right?
one thing,
So it will reset.
it will reset. So it's very easy to change from one insurer to other insurers and all that when it is step premium. Because everywhere when you enter, it is your age which is going to be considered. But when you take level premium, after 2 to 3 years, it is very difficult to change over if you are taking level premium again. Because no other insurers can beat it because you entered at the age of 27 and now you are 30. So now when you enter with another insurer at level, so they are going to calculate at the age of 30. But when you took a level cover at the age of 27, you were 3 years younger. And in life insurance, the greatest risk is your age. Nobody will be able to match it after 3 years.
Yeah.
One very important thing, whenever you are thinking of switching from one insurer to other and all that, remember you have to keep in mind that when you took the earlier policy, did you have any medical conditions or not? When you're switching, are you having any medical conditions or not? Because otherwise, you're going to have a bigger disadvantage of not being covered or being loaded. In most of the conditions, there are some conditions where this will not apply. Say blood pressure, it might not apply. Okay.
Yeah. There's a question from Raj. Can we pay for external income protection from Super?
What do you mean to say? You mean to say you have your default covers in Super, but you want to pay the premium from your pocket?
No, no, no. If we get a income protection insurance from outside, can we pay
Yes.
it from Super?
Yeah, you can. Remember one thing, but if you are paying anything which is paid via super, you do not get tax deduction. Okay, I got it. Yeah. Only if you pay the premium. So therefore, you should not have your income protection policy within your super. First of all, the benefits are very poor. Okay. Secondly, remember one thing, how the benefits are poor. Most of the super will give you many a times a waiting period for 90 days. Okay, I will bring this point up since this has come into play. There are two important parameters when you take income protection cover. Okay, the two important parameters are what is known as a waiting period and a benefit period. Okay, so if somebody's got a waiting period of 14 days, they can take waiting period for 14 days, 30 days, 60 days, 90 days, or 2 years. So suppose somebody's got a waiting period for 30 days. It means that you cannot submit a claim unless and until you are not able to work for more than 30 days. Okay. What super does in most of the super policies, the waiting period is 90 days. As soon as they give you a waiting period for 90 days, I can list you so many medical conditions where you can never put in a claim. For example, fractures. Most of the fractures, you will go back to work within 2.5 months. If you've got a 90-day waiting period, you can't put in a claim, which means you're paying a premium, but you can't get a claim. And therefore, that policy is cheaper. Same way, the benefit. The benefit can be for 2 years, 5 years, up to age 65. Okay. Now, if somebody's got a benefit up to 2 years, the policy is valid up to the age of 65, but they can claim for a single medical condition or accident and injury maximum for 2 years. While the policies which you take with an insurance company, you can have 5 years, higher waiting period, less. That's how they also become better. And not to get into more details, partial disability, total disability, this is a very complex area where the income protection policies within your super are very poor.
So I think the best idea is to reach out to you to discuss it
Yes,
personally. You have
yes.
kindly offered complimentary
Free,
insurance check
free.
and
And if
also,
everything is good for you, I'll tell you continue with it.
yeah.
My idea is not to
So even if it's
basically create anything, but to see that you are covered in the best way. And it's the most important thing is that you structure your policies well. Most of us need all these policies after 50, 55. If you go on paying premiums from the age of 25 or 30 till 50, 55, you can't keep those policies. You've wasted your money.
Yeah.
And as I said, I want to impress this again and again. the cumulative premium you pay for step premium is much, much, much higher than what you pay for your level premiums.
Yep. Raj, you want to add something? Raj, what you want to add?
Yeah, no, I was saying like, say if the income protection is not the default one, the one that super company might provide you. If it's like external to the super, so then you're saying it's not beneficial to pay it via super?
No, what I'm saying here is if you take your policy with an insurance company and pay your premiums via super, which is
Yep,
allowed, you will get
yep.
much better benefits that is guaranteed. Because what the insurance company does it, whatever super can't give you, they will give you. Okay. So
Yeah,
that is
yeah,
one
yeah. Right.
advantage. The
Yep.
second thing, what I'm trying to say here is that anybody who's earning on the higher side, whose
Yep.
tax slab is high, should ideally
Hmm.
pay the premiums from the pocket because you are paying much less premium.
Yes, effectively.
You
Yeah,
see,
because you
effectively,
can
especially
claim it.
people who are on tax slab of 35, 37, 40. I've got a lot of clients who are Indians and other fields who are IT and other, they are earning in 200 plus.
Hmm.
Now, you can imagine you are getting 40% back into your pocket. You
Yes.
paid a premium of $1,000 and you're getting 400 back.
Yeah, because you're in a higher tax
You
slab.
see,
Oh,
so
Yeah.
so
what
it's a
I'm
tax
trying to tell you
deductible.
here is, sorry,
Insurance premium is tax deductible, is it?
only income protection.
Income protection. Okay.
Yeah.
Yeah.
Only
And that is the
income protection.
costliest policy.
Yep.
So remember one thing, Raj, that
Yep.
if you take a policy even from the super, even with an insurance company, but pay your premiums from your super, you will get 15% rebate. So 15%
Right.
premium will be less. Okay.
Ah, yes.
Because
You get the
anything which
rebate.
is paid via super, you get 15% rebate, whether
15%
it is your
rebate. Yes.
life policy,
Yes. Yes.
TPD, income protection. The
Ah,
advantage with
okay.
income
Okay.
protection is that income protection premiums are the only premiums which are tax deductible. They're not tax deductible for life and TPD.
No, yes.
And therefore, we keep it in super so that your premiums remain less by 15%, at least till the age of 50, 55.
Yeah, makes sense.
And we also don't want to drain our super after 60. We are going to get that money back.
But the other thing I noticed about life insurance in Australia is that, like in India, you get the lump sum amount after the policy matures.
Yeah.
But here you don't get that. Or do you have
Okay.
that option in Australia? Something
Very good.
similar.
No, those kind of policies are also available here, Raj. Okay.
Ah, okay.
Remember one thing. Remember one thing. When you get that, I had that policy in India. Okay.
Right, right.
When you buy that policy, the premiums are much higher.
Yes.
You do one thing. You ask for $2 million simple policy, and then you say, okay, I want 2 million after so many years. I'll pay for 20 years, and then you give me that money back. Okay. You are paying much, much more premium, and then they do that
Yeah, yeah.
calculations where they pay you a
Okay,
little
so they
more.
like
But what
they
is the
invest on
value?
your behalf,
You have to
basically.
look at this in a different way here.
Yep,
In a country like Australia,
yep.
if you do see, this super is a brainwash. It's taking us for a ride. Okay. If you buy an investment property
Yep.
whereby you pay 10%, I'm also a financial planner, all insurance, but I only specialize in life insurance. Okay. Yeah. So this
Yeah.
is all general advice. Remember. Okay. Remember what is important here. Suppose you buy an investment property, you pay 10%. Okay.
Yep.
Your renter, you get rent and all that. That will most probably double in 10 years. Are you bothered about super? Is super going to do that? No. So I
No,
even
yes.
tell my clients that if you are paying the premiums from your super, please save that money, buy an investment property, don't worry about super.
Right, yes.
So the strategy what applies in India does not apply here,
Okay, makes sense.
because
Yep.
here you are still able to pay the premiums from your super. Your money is jammed till 70.
Yeah.
Raj, we have a saying in our community, if the money is not in your hand, it is not your money.
Yeah, exactly.
It is like my dad saying, Chandresh, don't worry, I've kept 5 crores in the vote for you. I've told my barrister advocate that at 70 he will give you that money.
Yep, yep, yep.
You see? So
And if you take the life insurance without the um, maturity date, right?
Mhm.
Like in Australia, we usually take that one. I think it goes on forever, right? Even if you are like 80 years old,
See,
there is
life
no
death
like,
policy is the only policy. Income protection and TPD policies finish off as soon as your super finishes or as soon as you retire. Suppose Raj, you decide to retire at 60. Okay.
yeah,
What is income protection and TPD? They are both related to your earning ability.
yep,
Income protection compensates you for the loss of your earning if you are earning an income. And if you are
yep.
not able to do so due to accident, sickness, injury anywhere in the world. So if you have stopped earning, your TPD and income protection policy should be closed. They should be done and dusted. So there are only
Oh,
two
okay.
policies which go beyond 70. One is your life death policy.
Yep.
If you start paying from your pocket, and that is where I come in, and I tell you it is a complete retirement planning for the second partner. It's a
Mm-hmm.
large amount of money which you pay.
Yeah.
And we are Indians. We are smart people. Okay.
Yep.
So remember one thing, why should I waste what I have paid? And where am I going to get tax free money? Even if I'm going to put my house on my son's name, he's going to pay tax.
Mm-hmm.
And when the second partner puts it to the children, they will have to pay tax. But imagine 3 million of which they have to pay 300,000. They're still getting 2.5 mil.
Yeah.
Are we not doing something for the next generation?
Very knowledgeable,
So
And
Chandresh.
is
let
it
me
only
tell you one
10%
thing.
you're saying, yeah?
I always bring this point of view to all my clients. And some of them say, because there's a simple saying, oh, this policy is not going to be useful for me. There, I forgot to tell you one thing. There is a very one important good benefit within life death policy, which is terminal illness. So,
Mm-hmm.
what it states is that if the policy holder will not live for more than 2 years, yeah, we pay off the
Yep.
complete death policy when the person is living. I have paid these
Oh.
claims. And I've seen that gentleman using that money to go and do treatment in USA, and he's living today.
Oh
They
my
send
gosh.
us thank you cards, flowers when we pay the claim. If we don't pay the claim, we are devils. We have to be careful. That person might hit me outside.
Yeah.
So understand one thing that and the second policy which remains, the second policy which remains up to 80 is your critical illness. So up to 70,
Mm-hmm.
it covers 42 serious medical conditions. Between the age of 70 and 80, it turns into inability to perform two important duties of your daily living.
Mm.
See,
Right.
let me assure you one thing. I've got a wealth of knowledge and I'm here to share with the community. I have no personal intention or gaining. I'm at that stage of life. I don't need to take money somehow. Yeah, I'm here to give back to the community what I have learned, and I'm very passionate about it because I've seen for 14 years when people are on claim how desperate they are and what horrible life situation in which they are.
Yeah.
I've seen people selling their houses because they could not pay for the serious medical conditions. They said, we can rent it, but at least get the money.
I'm,
I've seen families broken when people are not able to earn for more than 1, 2 years.
I'm conscious of time and there are two more questions to cover.
Yeah, sorry.
Apologies. Rajesh, thank you
Yeah, no,
for
Sorry.
questions.
thank
Yeah.
you.
So the one question from Dr. Teju
Yeah.
uh, is can we pay the premiums of TAL policy from Super? Is it better strategy? And what are the disadvantages?
So, as I said, being a doctor, I assume you're earning on the higher side. Okay. Yeah. If your tax slab is higher, hmm, you got a policies with TEL, is it? Okay. Now, if you got policies with TEL, are you still paying from Super for your income protection?
No, personally.
Personally, which is good. Yeah. So what was your question then?
Uh, I thought if we can pay something from super, it just maintains we don't have to pay from our account.
Yeah,
We can
so
save.
you can pay your life policy from your super. You can pay your TPD policy from super.
Yes. Okay.
But have you got two TPD policies? So when you have a TPD policy in super, you need to have any occupation in super and own occupation outside, paid from your pocket.
Okay. No, that's
Because having any occupation policy for a person like a doctor, any occupation policy is absolutely rubbish policy. You're paying free money to the insurance company. One can get a claim only when somebody becomes a vegetable. If I, with all due respect, doctor, but you can get in touch with me. I'm not here to make any, but I can advise you the right thing.
Okay.
Or you
that
can
sounds
send me
great.
your policies for review.
Yeah. No, I think I should meet you.
Yeah, I've got lots of consultants, specialists, doctors all over Australia.
Yep.
Yeah.
Yeah?
Definitely.
And for doctors, you have to be very careful because there are some special things which are available for you, such as needle stick injury, blood-borne diseases, which are covered within your trauma critical illness policy.
Yeah.
I don't know whether you have needle stick injury.
Yes, I do.
Yeah, good. Yeah. So there are a lot of things like that which needs to look into. Having being a claims assessor myself, I've dealt with it, and being a medical specialist, all those complex medical things come to me,
Yeah, no,
used to come
definitely. I
to me.
was looking for someone like you. If you can
Yeah.
leave your sort of details, we would.
Yeah, you can. Suryaji is also there on the screen right now. I don't know.
Definitely.
Yeah. And I'll connect you both, and thank you
See, I am
again.
here just to see that the families are protected and you have a good cover. And this is the most important pillar of financial planning. I always tell anybody I come in touch with my folded hands that if you have your policies in super, please come out.
And this is the gist of these webinar series, that
Yeah.
person like you who are at this stage of life where money does not matter to you, but you want to give
Give
back
back
your
to the
experience,
community.
give back your experience, life experience to back
Yeah.
to the community. And we all are 11 people on this call are all fortunate, 10 people on this call are fortunate to hear from you free of charge for the welfare of the community. With that note, I'll take a final question from Vimalji. He has put a question in chat. Can insurance premium paid from super for income protection are tax deductible or not?
No. If paid via super, you get 15% rebate. That's it. You cannot claim any tax deduction, which means if you got your policy within super, come out of it, because even the definitions of partial disability, total disability is very poor. See, those small nitty-gritties takes time to explain. It's very difficult for people to get it, And one more thing before I go, Suriji, if people want, I can also do one special thing for businesses. It's a very important thing, for example, especially for partnerships. So if there are two partners and if one partner passes away, what happens? The other partner's wife will say, give me the money. The business might not have the money to pay.
Vimalji, Chandresh might be good speaker for your CA forum.
Vimalji, I was basically invited to speak to the Chartered Accountants Association of India maybe a few years ago.
Oh, that's so nice of you. So even
I
we
did
can,
speak at
yeah.
the Docklands Library.
Oh, that's good because even I was heading chairman as our
But I
Institute
can
of
come
Chartered
in. I can come in
Accountants.
again because I think I've got much more knowledge now what I had 3-4 years ago. Every day I learn something new.
Definitely. This was very much informative and excellent session.
Oh, I've got a lot of
Suryaji,
things to
thank you.
say, but I just concentrated on why not to have your policies within your super.
No, that's fine, sir. Thank you very much, and definitely we'll invite you. I'll connect Suryaji, and then we'll
I'll
invite you
connect
for
you
sure.
both. We'll
No
connect
worries.
you.
I also speak to the BAPs. I also speak in my community. Just educate them.
Okay, sir. Nice of you. Thank you very much.
Yeah. Anybody who's interested, they are most welcome. I'm not going to charge you any fees. I don't charge anyone. Let me tell you that on the face.
No, I highly appreciate it, Chandresh ji. You have even what you may want to speak for another few hours, and you will still educate us a lot. but whatever you've spoken from your heart. We have learned a lot. This is the first time I learned that income protection insurance is a tax deductible, and that would have provoked me to get that insurance sooner than later.
Yeah, send me your existing policy, Suri, for
I'll connect with you
review.
definitely and get more advice. Highly appreciate your time and energy and knowledge and wisdom you've shared with the community. I encourage all the audience and people who are watching on to YouTube, please like, subscribe, and share this video, and also share some more interesting topics and speakers for this forum, for this webinar series. Sandeep, do you want to comment something? You unmuted briefly. Sandeep ji, you unmuted. You want to say something?
Yeah, I just wanted to thank Chandresh ji for his valuable insights.
No, you're most welcome. It's my pleasure to talk to you, and thank you for your time, to allow me to give back whatever I can.
I really appreciate your time, and if the community needs more, we'll invite you again, Chandresh, on this forum.
Absolutely. I'll be most happy,
We are so thankful on behalf of FI. We want to thank you for coming on this forum, sharing the wisdom with the community. With that note, sabko namaste, good night.
Thank you. Namaste, everyone. Good night. Thank you.